This video is for informational purposes only and is not financial or investment advice. Consult a tax professional. The core of cryptocurrency taxation revolves around specific taxable events, as the IRS treats cryptocurrencies as property, not currency. While simply purchasing crypto with cash and holding it isn't a taxable event, selling it for fiat currency or exchanging it for another cryptocurrency is taxable. Did you know your Bitcoin sale could trigger taxes? The tax is incurred when gains are realized. Even if you convert one cryptocurrency to another without first converting to US dollars, it's considered a taxable event. Earning cryptocurrency through mining, staking rewards, or airdrops is also considered taxable income based on its fair market value when received. If you receive crypto as payment for goods or services, its fair market value at the time of receipt is taxable income, just like receiving payment in cash. Using cryptocurrency to purchase goods or services is treated as a sale for tax purposes, which can result in a capital gain or loss. Non-fungible tokens, or NFTs, are also considered digital assets by the IRS and are taxed similarly to other cryptocurrencies. Selling or trading NFTs can trigger capital gains, and if you create and sell NFTs, the revenue is generally taxed as ordinary income. A crucial aspect of crypto taxation is the distinction between short-term and long-term capital gains, as this directly impacts the tax rate. If you hold a cryptocurrency for 1 year or less before selling, any profit is a short-term capital gain, taxed at your ordinary income tax rate. If you hold for more than 1 year, any profit is a long-term capital gain, generally taxed at lower rates. Holding assets for longer than 12 months is a common strategy to potentially reduce your tax bill. Accurate reporting of cryptocurrency transactions is essential for compliance. In the US, you'll use forms like 8,949 for sales and exchanges and Schedule D for capital gains and losses. Income from mining, staking, or airdrops is reported on Schedule 1 or Schedule C, depending on whether it's hobby or business income. The IRS generally defaults to the first in, first out, or FIFO method for crypto, meaning the first coins you acquired are considered the first ones sold. Maintaining detailed records of all crypto transactions, including dates, values, and types of activity, is paramount. Starting in 2025, crypto exchanges must report certain digital asset sales and transactions on Form 1099-DA. Even if you don't receive a tax form, you are still responsible for reporting all taxable crypto transactions. Failure to report all taxable events can lead to IRS enforcement letters and penalties, as the IRS is actively cracking down on tax fraud. U.S. citizens and residents must report worldwide income, including cryptocurrency holdings and transactions on foreign exchanges. Additional informational returns like the Foreign Bank Account Report, or FBAR, and FATCA reporting may be required if foreign crypto assets exceed certain values. Ensuring compliance with cryptocurrency tax regulations can be complex, but several strategies and resources can help. Utilizing crypto tax software can help you track transactions, calculate gains and losses, and generate the necessary tax forms. For complex crypto holdings, or if you're unsure about specific tax implications, consulting a crypto-savvy tax professional is highly recommended. Tax rules are continually evolving, and professional guidance can help ensure full compliance and maximize tax-saving opportunities. Strategies like tax loss harvesting, holding long-term for lower capital gains rates, and gifting or donating crypto can also be beneficial. This video is for informational purposes only and is not financial or investment advice. Consult a tax professional for personalized guidance.
If you want more crypto updates, market analysis, and breaking news, hit the subscribe button and turn on notifications.